Hey everyone, welcome back on the channel, and in today's video we will be talking about Pendle Finance and their whole narrative of yield tokenization. That's what makes Pendle Finance special, that's what sets it apart in DeFi, and that's the narrative that they introduced to the space back in the days of, I think it's 2021, but I'm not sure. So let's jump in here on DeFi Llama. Yeah, 2021. So they came up in the summer of that year, and for the most part nothing much happened. I mean, we saw some growth here and there, and during the height of the bear market I didn't think it was dead. There was some action going, but not too much. I mean, the TVL went down, as with everything in DeFi. After all, it's the DeFi market. It's the bear market. Nothing in DeFi was pumping. But the pages turned in the year of 2023, and look at this bullish momentum. Keeps on pumping that TVL until today. We're sitting at an all-time high of over $230 million locked, and the Pendle token price also appreciated quite a lot for the past few months at least, now sitting at a little over $1. So things are looking good for Pendle Finance, and that's why I decided to make this video, introduce you to the whole concept that they bring, which is trading of tokenized future yield on an AMM system. That's what Pendle Finance brings to the table. That's what it makes it unique, and that's the whole concept I want to share with you. And by the end of the video, hopefully I did a great job at explaining and you'll understand how it works, okay? So we will be taking a look for that into their own tutorial that they have under the education tab right under app, and it's a really great looking tutorial, I gotta say. It does a great job at summing up everything that is on the white paper, but it's not obviously as full on in-depth dive as the white paper, but still it does a great job at explaining. It keeps it simple, and it's very easy to approach for everyone, even newcomers to DeFi, right? So we'll be going back and forth in between both the tutorial and the market, the trade markets here on Pendle Finance that you are just looking at right now. Let's just wait for this to load up properly so you can see there's going to be maturity, there's going to be underlying APY, there's going to be PT tokens, implied APY, YT tokens. So you see, YT, long yield APY, PT, fixed APY. We'll understand all of those things. We'll talk about that. So that's what I'm going to tell you, how it works, what you should look out for, etc. Okay, but before getting into it, let me just showcase what the Pendle team dropped or delivered so far. So really good. And by the way, they're doing ARB season, and you can benefit from Pendle Finance the traditional DeFi way, which is providing liquidity, etc. But that's not the point of this video. Here we'll look at the core tech of Pendle, yield tokenization. All right, but like I said, like I was saying before getting into it, take a look at this. Cross-chain compatible. You got 4 blockchains of choice to use Pendle with: ETH, R, BNB, and Optimism. The former 3, I mean, they are much cheaper in gas compared with Ethereum, which is quite hefty. So if you plan on doing often trades in Pendle Finance, you should be aiming to use ARB, BNB, or Optimism. But anyways, it's up to you. One other thing, since they bring a new concept and they have a new approach to DeFi, 6 audits. That's something that I understand why they did, and I like teams who do this, who commit themselves to the protocol, and that was shown by the previous years, where even though we were during the height of the bear market, these guys kept on pushing and improving the protocol. And 6 audits, guy, cross-chain in 4 blockchains and 6 audits. Most big players in DeFi have a couple. These guys have 6, and at the same time, don't get carried away by it, because we saw and we keep seeing daily some crazy stuff happening in DeFi, even with major players. So don't take this as a full-on proof that everything is good and will be good. I mean, it's great. Don't get me wrong, it's great. I love to see 6 audits on it, but don't get too carried away by it, all right? It just tells us that 6 different eyes at least went through the contract and found nothing that could be exploited. That's what it means. Nothing more, nothing less, okay? So that being said, let's take a brief look here at the core tech, yield tokenization. So the way Pendle sees things, when you buy a token, which is a yield-bearing asset, because well, you can stake it anywhere in DeFi and earn yield by it. That's what the yield-bearing asset is. So you can buy it and then split it into two parts, yield and principal, those two components for, and you can split into those two for maximum control. So you can start to play around with principal and yield to make profits out of it using the Pendle AMM, designed for yield trading with concentrated liquidity, dual fee structure, and negligible IL, impermanent loss concerns. Okay, so this is Pendle in a nutshell. All right, now let's jump in on the tutorial. So right now there are three things I want you to take note of. It's maturity, PT, principal token, and YT, yield token. So these are three key concepts. Now, we'll have 4 points here on the tutorial. The first one will be introducing you to the concept of yield tokenization. The second one will be introducing you to possible strategy, and that strategy specifically will be telling you how to fix your yield, where you can lock in a guaranteed fixed yield. You know, in DeFi, when we provide liquidity, when we stake funds, we always are subject to APYs fluctuate. In here, you'll get a fixed yield. It's not going to fluctuate. Okay, so you can already see the potential of Pendle. The third level here will be also regarding the strategy, longing yield. So in this case, you will speculate regarding the yield of a particular asset, not the value of a token, but the value of the yield of that token, if the yield will grow or decrease. Okay, so that's what this strategy will focus on. And the level 4 will be active yield trading, just by switching positions between principal and yield to profit from yield volatility and get a better APY on your underlying asset. Okay, so that being said, let's jump in on yield tokenization, the main concept of Pendle Finance. So in this concept, what you can take away from it is that you can separate a token into two main components, which are the PT and the YT. So in a traditional protocol in DeFi, what you do is that you grab your tokens, in this case is 100 DAI for example purpose, you stake it in Compound for 3 months, after which you can take it back and you'll get your not only your principal but also your yield after 3 whole months. In Pendle, the staked DAI position can be separated into two, PT and YT. The same 3 months will be what they call the maturity, the time to maturity. So you can do two things. You can use PT or use YT, buy or sell, either, depends on your strategy. So in the case of holding PT, people can redeem the principal amount after maturity, which would be after 3 months. So after 3 months, the person who owns PT, when it reaches maturity, will be the owner of the token. The yield tokens are the tokens that will yield earn new yield during the time that it takes to reach maturity, the 3 months period. They will earn new yield during that time to the person owning the YT tokens. Okay, so if you own PT, you have the rights of ownership to the token. When it reaches to maturity, you own it fully. All right, so you get not only the PT but also the YT after the maturity time is reached. The YT will earn new yield during the staking period, but when you reach maturity, you stop earning yield. All right, so that's why it's very important to know what maturity is and how it works. So by holding PT, people redeems it after maturity, and by holding YT, people receives continuous yield of the staked token during the entire duration of 3 months. All right, so they have further examples down here, but for the sake of the video, we're gonna keep it short and straight to the point, okay? Not aiming to make it too long of a video, right? So let's jump in to point 2. Now this is the first strategy that they show you, fixing your yield. So yield usually in DeFi is volatile, it fluctuates all the time. But in this case, if you are trading PT, if you decide to buy and hold PT, your yield will be fixed, okay? Although you can buy and sell PT on the Pendle AMM at any time, it's up to you. But if you decide to hold, well, you will get fixed yield. The PT price is determined as always by market demand and supply. So people is buying PT for DAI staked in compound known as PT DAI because PT DAI does not include the yield component. PT DAI will always be cheaper than one DAI because it does not include the yield. So you will not be earning yield directly, okay? That's why it will always be cheaper than one DAI. And by the way, you probably know this, but DAI is pegged to the dollar. So one DAI is worth $1, meaning that PT will always be cheaper than one DAI. And this is something that is applied for all PT, be it DAI, ETH, Frax, you name it, okay? Any PT in Pendle will always be cheaper than the whole token, all right? So after buying one PT DAI at discount price, so in this case, the example is 90 cents, people can redeem one DAI for his PT upon maturity. This is fixed return. You see again, the fixed return. Why is it fixed? Because you already know, you buy it at 90 cents, but you know that by the end, when it becomes mature, these 90 cents are worth $1. So it's a fixed yield, since the amount of DAI redeemable at maturity is fixed. Now, this is the diagram that shows it. Buys one PT at 90 cents. 1 year later, redeems one DAI. So you see 90 cents became $1. So in practical terms, it means that those 90 cents or that PT earned you 11% APY on top of the value that it had, the 90 cents, plus this 11%, you redeem one DAI. So you automatically got a fixed 11% APY, and it's gonna be fixed no matter what when you buy it and decide to hold it. So this is the PT trade, what they call the PT trade, buying and holding PT to maturity equals receiving fixed yield. So you can buy any token on Pendle at a discount if you decide to go for the PT, be it ETH, be it DAI, be it USD, doesn't matter. You will always get a discount. And that's where it comes, your strategy comes into play. So let's switch up here onto markets so we can see how big or how low of a discount you can get. I mean, it's all a matter of opportunity, finding the best opportunity and make the best call. For example, here with ePendle, the implied APY is 10%. So the implied APY will always be the fixed APY that you will get when you decide to buy and hold PT. Always, regardless of the token. You see, the implied percentage is always the same as the PT. You see, everything is the same. Now, and even if you go back down, I mean, implied APY is always the same. So this is the APY that Pendle is paying here on their protocol, and the underlying APY is what is being paid for staking that token in other DeFi markets. It's an average of what the whole DeFi market is paying out for staking, okay? And the implied is what you can get here on Pendle Finance. So it's a very interesting concept you see already, and I mean, whenever you find a big fixed APY here, I mean, go for it because it's going to be a good option. And for example, ETH, let's say you want to buy ETH at a discount here. We're having these two examples here on Swell. The implied APY is 3%. In practical terms, you already know that if you buy Ethereum here, you'll get a 3%, so to say, discount because you know that this price will appreciate until maturity, until these 391 days go by, it will appreciate 3%. You see, that's how you can read things. Here with the ST ETH on Lido, it's a bit higher. It's implied APY 3.6%. Here on this case, since the maturity is different, you have different values. You see, the same token ST ETH on Lido, but here the discount is higher. The implied APY is 3.9. And another example here, it's a different 3.7. So you got plenty of options, okay? Mostly what is changing here is the days to maturity, but the token is the same. So you gotta be your own, make your own choices and choose if you're doing a good job or not, okay? So this is what the PT stands for, the rights of ownership of the token, and how you have to wait for maturity to be reached until you can redeem your whole token. Because when you get to maturity, you not only get the PT, you redeem the whole thing, you see? You get the token PT plus YT. They use a really good and cool example on the white paper, which is the owning rights of a building. So if you have the PT, you have the right of owning the building. The building is yours. But the person who has the YT is the person who can profit from using the building during the time that it's taking to reach maturity. All right. So let's go on and see what they tell us when it comes to the YT or the yield token strategy. So you can use the Pendle AMM to buy and sell both PT and YT. So in this example, let's say people is buying one YT. So he does not want, for whatever reason, buy Ethereum, but he wants to own the rights of earning yield on one Ethereum because he thinks that Ethereum will be paying really great yields. So he decides to buy one YT ETH, which is trading at 0.04 and the maturity of 1 year, and he will hold it. So giving him the right to receive the yield on one ETH until maturity. So now people is thinking, and that's why he bought it. 0.04 is cheap, and in 1 year, when it comes to maturity, it will generate more than 0.04 because, like we already said, APYs fluctuate in DeFi markets all the time. So this 0.04, people is speculating that it can go up in price. So he chooses to buy one YT. So the rights of earning yield on ETH, on one ETH. And since he did it, after 1 year, yield turns out to be 0.05 ETH. So he got already a 25% APY on his one YT ETH investment. So yeah, people did a good choice. But at the same time, he could have been wrong, and that's the risk. We are speculating on price appreciation, just like with any other token that we buy, just that in here we are talking about yield and not the ownership of the token itself, okay? So people profits as the future yield he accrued is greater than the price of YT ETH when he purchased. Basically, he is holding ETH yield. Buying and holding YT equals to longing yield. Profits equal to future yield minus YT cost. Of course, if the future yield is lower, you incur in losses. All right. So they have also a very handy information down under here, which is if you read implied APY versus the underlying. So if the implied is low compared to the underlying, that means that it's likely that you will profit. And the opposite also, of course, is true. If implied APY is high compared to underlying, you are less likely to profit. Likely doesn't mean it's guaranteed, okay? Have that in mind. So let's take some examples here. The first one with Pendle is a good one again. Implied APY here is 10, the underlying is 17, so implied is lower than the underlying. Theoretically, it's a good call to long yield with this one because hopefully this will move upwards trying to meet this underlying APY, the APY that DeFi markets are offering on average. And if that happens, you will successfully long yield. Okay, at and just one quick thing. Although the maturity is 300 days, you don't have to long it for 300 days. You can long it for a month, 2 months, how you see fit. You can sell it at any point in time. This is true for both PT and YT. That's what makes Pendle so special. You can change this all the time. But if you think like people that after 300 days this APY will be higher, yeah, go ahead and long it, okay? Because it's going to be a good call. Basically, this is how it works. The whole concept of yield tokenization. How can you profit from holding PT or holding YT? Okay, and the main aspect here is the yield, because the yield that you are earning, that is what is going to determine if the principal token rights are cheap or expensive. If they are cheap, meaning that the YT is expensive, then the implied APY is high. If the implied APY is low, PT is going to be expensive, but yield is going to be cheap. Okay, theoretically, this is how things work. So, for example, here, Frax, negative percentage on longing yield. That's because the implied is higher than the underlying. So this is expected to go down. So if you would buy or if you would long yield APY now, probably in these conditions you would be losing money. Remember, let's go back here on the tutorial. Let's go back here on YT. Implied APY is high compared to underlying. You are less likely to profit. Doesn't mean that you can't, but you are less likely. And you will incur in losses. Okay, so this is how Pendle Finance shines, and this is how it differs from any other protocol in DeFi as of now. You see, there's a ton of potential. PT plus YT, they make the whole token, but you can just play around with these values and with market fluctuations and trade one or another or both even during the time that the underlying token is getting to reach maturity. Okay, so hopefully this was a really good source for you to understand how can you benefit from Pendle Finance, how this whole tokenization or future yield tokenization works. And yeah, thank you for watching, guys. If you have any questions, feel free to drop them down under in the comment section. Make sure you hit that like button and subscribe if you enjoy this type of content. I'm probably going to post more about Pendle because they have a ton more to offer, but this is their main concept that they introduced to DeFi, and that's what I wanted to share with you and discuss about. Okay, so thank you for watching. I'll see you on the next one.